In the cyclical world of finance, history often repeats itself. But what if I told you that the ominous clouds hovering over the stock market this September are not just a regular storm, but a tempest that could eclipse some of the darkest moments in financial history? Stay tuned to uncover the hidden truth behind the September storm and the tools you might need to weather it. The historically low stock market returns seen during September are known as the September effect. Going back almost a century, September has had the weakest performance on average. The September effect is an example of a calendar-based market anomaly, defying the efficient markets hypothesis because it happens without any apparent cause or event. Depending on the period examined, the September effect has a statistical basis, but most of the idea is based on anecdotes. However, in recent years, September's median return has been favorable. The S&P 500 index has typically had a drop in September from 1928 to 2021. However, this represents an average over many years, nearly a century, and September is unquestionably not the worst annual month for stock market activity. September has historically ranked among the highest performing months. So, does this mean a correction occurring in September is a myth? And is it just a storm blown by bears in favor of them? Well, let's see. Even though September's median return is now positive, the month's average return is still negative. The September effect is not overpowering. More importantly, it is not predictive in any meaningful way. It may offer a market anomaly because it goes against the premise of market efficiency, and this is because the time frame will have a significant impact. For instance, if someone had placed a wager against September for the past 100 years, they would have come out ahead. However, the investor would have lost money if they had only placed that wager in 2014. So what is the reason behind the September effect? Investors typically return from summer vacation in September, keen to lock in profits and tax losses before the year ends. Another common misconception is that stockholders sell their holdings before school starts in September to help pay for their kids' tuition. Additionally, as investors anticipate the September effect, market psychology takes hold, and the mood shifts to the downside in line with these expectations. Institutional investors can also sell as the third trading quarter finishes in September. They can secure some profits for the year's conclusion if they want. Another fact is that many sizable mutual funds sell their holdings at the end of the quarter to take advantage of their tax losses. However, economists mainly dismiss the September effect as insignificant, and even if it did exist in the past, traders who are aware of the anomaly currently operate in a way that effectively eliminates it. Furthermore, September has not experienced frequent big drops as frequently as it did before 1990. One explanation is that investors have pre-positioned or sold more shares in August in response. Do you know that similar to the September effect, we have the October effect too? It implies that October will also be a poor month for the stock market. Despite being the month of the 1907 panic, Black Tuesday, Thursday, and Monday in 1929, and Black Monday in 1987, October has had a net positive 100-year history. Additionally, the October effect, like the September effect, depends on the considered period. Analysts and economists also doubt the October effect's existence, and even if it did exist, it appears to have vanished. Does this mean that September is a bad month for stocks? What do you think? Depending on the period you consider, September has historically had the poorest stock market performance, losing an average of 1%. Since 1928, stocks have lost money in September 55% of the time, giving the month slightly higher than a 50 by 50 likelihood. On average, September has been the month when stocks have performed the poorest in the past century. Additionally, it has had the most low months throughout the same period. However, the majority of economists have attributed the effect to chance. The September effect may or may not exist, depending on the time frame being considered. Research examining data from the United Kingdom since 1693, an even larger time frame of almost 300 years, shows no evidence of the effect. For 3 of the 6 50-year periods, September mean returns are greater than those in the other months, though the difference is not statistically significant. According to a purported market quirk known as the September effect, equities tend to decline during September. Although September has historically been the worst performing and most usually negative month, the time frame being considered is quite important. There is no September effect if we go back much earlier to the United States 1800s or the United Kingdom's 1700s. Since markets typically function efficiently, all abnormalities are likely thought to exist in the stock market. As a result, it is probably not a good idea to base trading decisions on the concept of the September effect. Let's look at how the market performed in the previous months. In August, the 2023 stock market paused as investors debated whether the most recent economic statistics would force the Federal Reserve to raise interest rates at least once more before the year's end. Moreover, the S&P 500 experienced a 1.4% decline in August, bringing its gains for the year to 18.8%. Investors were put off by remarks made by Federal Reserve Chair Jerome Powell at the Jackson Hole Economic Symposium that suggested additional tightening of monetary policy may be on the way. While everything is going on, second quarter earnings figures have been inconsistent as businesses continue to battle with cost increases and the prospect of a U.S. economic slowdown. September's Wall Street headlines are anticipated to continue to be dominated by inflation, interest rates, and the labor situation. The Consumer Price Index increased by 3.2% year-over-year in July, less below economists' expectations of a 3.3% increase and down from June 2022's 9.1% peak inflation rate. The headline, CPI measurement, increased by 0.2% every month for the second month. Powell stated that inflation is still too high in his yearly address to the Jackson Hole audience in August, and he cautioned investors that we are prepared to raise rates further. Furthermore, he added that the Fed can proceed carefully at upcoming meetings due to decelerating inflation and a strong economy. At its most recent meeting in July, the Federal Open Market Committee hiked interest rates by another 25 basis points, bringing their target range to its highest level in 22 years, between 5.25% and 5.5%. Additionally, the FOMC's upcoming meeting, which concludes on September 20, is anticipated to result in the FOMC keeping interest rates at their current levels in its efforts to steer a soft landing. For the American economy, the Fed received conflicting information in August. In addition to CPI inflation coming in lower than anticipated, the Personal Consumption Expenditures Price Index increased from 3% to 3.3% year-over-year in July. The hot U.S. labor market is also beginning to cool off as prices climb. In July, the U.S. economy added 187,000 jobs, less than the 200,000 predicted by economists, according to the Labor Department. Since the COVID-19 pandemic lockdowns in March and April of 2020, the U.S. has added fewer than 200,000 employees. So, what points should you keep in mind while investing in September? Reduce your exposure to stocks in September if you're an investor worried about the U.S. economy's direction. Rising interest rates for high-yield savings accounts have been one of the benefits of the Fed's tightening cycle. The Federal Deposit Insurance Corporation insures some high-yield savings accounts, which allow investors to receive 5% interest while risk-free. So try to take advantage of this. When interest rates are high, value equities historically beat growth companies. High interest rates negatively impact discounted cash flow valuations, damaging high-growth firms. Vanguard Value ETF, Vanguard Small Cap Value ETF, and Ishar's MSCI EAFE Value ETF are well-known value exchange-traded funds. Additionally, since they provide earnings and cash flows that are typically consistent regardless of the economic cycle, some stock market sectors are seen as more defensive than others. typically regarded as conservative investments. Utility companies, consumer staple stocks, and healthcare equities may be reasonably shielded from a slowdown in economic development. The market's energy 11.9 and financial 13.9 sectors now have the lowest forward PE ratios, so keep these points in mind before an investment in September. Let's prove that the September effect concept is a myth. As we've delved deep into the looming September stock market crisis, it's clear that the implications of what's ahead might be even graver than many of us anticipated. But remember, knowledge is power, and being informed is the first step to prepare and navigate any storm. Before you go, if you found this video enlightening, please give it a thumbs up and share your thoughts in the comments below. Do you think the market will crash? How are you preparing for it? We value your insights. And if you haven't already, hit that subscribe button to stay updated on the latest market trends and insights. Until next time, stay vigilant and stay informed.